Hi all, welcome to the channel. And thanks for spending part of your time to spend here in this video. Today we will choose a current topic of interest with most of us. As a note, the content of this video is for informational purposes only and should not be used as a basis for making financial decisions. Now let's get into the video. Today's video we will see what caused 2008 subprime crisis and see if any similar kind of situations we are getting into with ongoing SVB crisis. What was the subprime meltdown? It was the sharp increase in high-risk mortgages that went into default beginning in 2007, contributing to the most severe recession in decades. Some of the key takeaways. The subprime meltdown was the sharp increase in high-risk mortgages that went into default beginning in 2007. The housing boom of the mid-2000s, along with low interest rates, led many lenders to offer home loans to borrowers with poor credit. When the real estate bubble burst, many borrowers were unable to make the payments on their subprime mortgages. The subprime meltdown led to the financial crisis, the Great Recession, and a massive sell-off in the equity markets. Understanding the subprime meltdown. Following the tech bubble and the economic trauma that followed the attacks in the US on Sept 2001, the Federal Reserve stimulated the struggling US economy by cutting interest rates to historically low levels. For example, the Federal Reserve lowered the federal funds rate from 6% in January 2001 to as low as 1% by June 2003. As a result, economic growth in the US began to rise. A booming economy led to increased demand for homes and subsequently, mortgages. However, the housing boom that ensued also led to record levels of homeownership in the US. As a result, banks and mortgage companies had difficulty finding new home buyers. Lending standards. These home buyers weren't approved for traditional loans because of weak credit histories or other disqualifying credit measures. These loans are called subprime loans. Subprime loans are loans made to borrowers with lower credit scores than what is typically required for traditional loans. During the early to mid-2000s, the lending standards for some lenders became so relaxed, it sparked the creation of the ninja loan: no income, no job, no assets. Investment firms were eager to buy these loans and repackage them as mortgage-backed securities, MBSs, and other structured credit products. Adjustable rate mortgages. Many subprime mortgages were adjustable rate loans. An adjustable rate mortgage, ARM, is a type of mortgage loan where the interest rate can change throughout the life of the loan. An adjustable rate mortgage typically has a fixed interest rate in the early life of the loan whereby the rate can reset or change within a certain number of months or years. In other words, ARMs carry a floating interest rate, called a variable rate mortgage loan. Unfortunately, when the Great Recession began, credit and liquidity dried up, meaning the number of loans issued declined. Also, interest rates began to rise, which reset many of the subprime adjustable rate mortgages to higher interest rates. The sudden increase in mortgage rates played a major role in the growing number of defaults, or the failure to make the loan payments, starting in 2007 and peaking in 2010. Significant job losses throughout the economy didn't help. As many borrowers were losing their jobs, their mortgage payments were going up at the same time. Without a job, it was nearly impossible to refinance the mortgage to a lower fixed rate. Meltdown on Wall Street. Once the housing market started to crash, and borrowers were unable to pay their mortgages, banks were suddenly saddled with loan losses on their balance sheets. In a foreclosure situation, banks repossessed the home from the borrower. Unfortunately, because the economy was in a recession, banks were unable to resell the foreclosed properties for the same price that was initially loaned out to the borrowers. As a result, banks endured massive losses, which led to tighter lending, leading to less loan origination in the economy. The losses were so large for some banks that they went out of business or were purchased by other banks in an effort to save them. Several large institutions had to take out a bailout from the federal government in what was called the Troubled Asset Relief Program, TARP. However, the bailout was too late for Lehman Brothers, a Wall Street bond firm, which closed its doors after more than 150 years in business. Once investors in the market saw that Lehman Brothers was allowed to fail by the federal government, it led to massive repercussions and sell-offs across the markets. Several sources have been blamed for causing the subprime meltdown. These include mortgage brokers and investment firms that offered loans to people traditionally seen as high risk, as well as credit agencies that proved overly optimistic about non-traditional loans. Critics also targeted mortgage giants Fannie Mae and Freddie Mac, which encouraged loose lending standards by buying or guaranteeing hundreds of billions of dollars in risky loans. Now let's see what is going on about Silicon Valley Bank, SVB. SVB provided financing for almost half of U.S. venture-backed technology and healthcare companies. It is America's 16th largest bank and was recently ranked America's best bank on Forbes' 2023 list. Nearly half of the U.S. technology and healthcare companies that went public last year after getting early funding from venture capital firms were Silicon Valley Bank customers. And how did SVB's crisis happen? The decline of Silicon Valley Bank partly stems from the Federal Reserve's aggressive interest rate hikes over the past year. U.S. Fed rates were near zero, banks loaded up on long-dated, seemingly low-risk treasuries. And with the incessant rise of the U.S. Fed hikes since 2022 to fight against inflation, the value of those assets has reduced, leaving banks sitting on a pile of unrealized losses. This prompted several tech firms to draw down the deposits that they held at SVB to fund their operation. As higher interest rates caused the market for initial public offerings to shut down for many startups and made private fundraising more costly, some Silicon Valley Bank clients started pulling money out to meet their liquidity needs. The SVB sold a $21 billion bond portfolio. Looking at all these factors, some analysts think that the SVB collapse is more company-specific for now. Hey all, thanks for watching the video, and please like if you find the information useful and share it with your friends. Go ahead and add your topics of interest for us to cover in the comments section, and see you soon in our next video with another topic of interest.